Ever wondered what role a central bank plays in an economy? It's time to uncover the mystery. At its core, a central bank, sometimes referred to as the monetary authority or reserve bank, is the backbone of a country's financial system. It's like the heart of the economy, pumping money through the financial veins and arteries of a nation. Its primary role is to manage the country's monetary policy. Think of it as the puppet master, pulling the strings of money supply and credit to achieve macroeconomic objectives. These objectives might include price stability, full employment, and economic growth, but the central bank doesn't stop there. It also plays a pivotal role in steering the financial ship of the country, ensuring that it sails smoothly through the rough seas of the global economy. Now let's dive into the specific functions of a central bank. First and foremost, the central bank is in charge of the country's monetary policy. This means it's responsible for managing the supply of money and credit in the economy. Think of it like a thermostat controlling the temperature in your home. If the economy is too hot with high inflation, the central bank might dial back the money supply to cool things down. Conversely, if the economy is too cold with high unemployment, the central bank might crank up the money supply to heat things up. This monetary policy is a vital instrument to achieve macroeconomic objectives. These objectives include price stability, keeping inflation in check, full employment, ensuring everyone who wants a job can find one, and economic growth, increasing the overall wealth and prosperity of the nation. Getting the balance right is a delicate dance, requiring careful monitoring of economic indicators and a deep understanding of how changes in the money supply can ripple through the economy. Next, we'll talk about how interest rates come into play. Interest rates can be thought of as the temperature control of the economy. Just as we use a thermostat to adjust the temperature in a room, central banks use interest rates to adjust the economic climate. Here's how it works. When a central bank wants to stimulate economic activity, it lowers interest rates. This reduction makes borrowing cheaper, encouraging businesses and individuals to take out loans. This in turn promotes investment and spending, which can spur economic growth. On the flip side, when the economy is running hot with prices rising too fast, the central bank can raise interest rates. Higher rates make borrowing more expensive, which can slow down excessive spending and investment, helping to cool down the economy and curb inflation. It's a delicate balancing act. Central banks must constantly monitor economic conditions and adjust interest rates accordingly to maintain a healthy economic balance. But that's not all. Reserve requirements also play a crucial role. Central banks also dictate how much commercial banks must keep in reserves. This is known as the reserve requirement. But what does this mean exactly? Well, in essence, it's a rule that requires banks to keep a certain percentage of their customers' deposits as cash, rather than lending it out. This cash is held either in the bank's vault or at the central bank. By adjusting these reserve requirements, central banks can control the amount of money that banks are able to lend. If the reserve requirement is increased, banks have less money to lend, which can slow down economic activity. On the other hand, if the requirement is decreased, banks have more money to lend, boosting economic activity. So, you see, by tweaking this one rule, central banks can influence the overall money supply in the economy, making it a powerful tool in their monetary policy toolkit. Now, let's look at how the central bank influences the market through open market operations. Buying and selling government securities isn't just for investors. It's a central bank strategy too. This tactic is known as open market operations, and it's a key tool for central banks to control the level of reserves within the banking system. Here's how it works. When the central bank purchases government securities, it's essentially injecting money into the banking system, increasing the liquidity. This action encourages lending and spending, which can stimulate the economy. On the other hand, when the central bank sells government securities, it's pulling money out of the banking system, reducing the liquidity. This move tends to discourage lending and spending, helping to cool down an overheated economy. So through these open market operations, the central bank can influence the amount of money circulating in the economy, impacting everything from interest rates to inflation. It's a delicate balancing act that plays a crucial role in maintaining economic stability. Now let's move on to the regulatory role of central banks. Central banks don't just manage money, they also manage banks. Indeed, one of the pivotal roles of central banks is bank supervision and regulation. This role is designed to maintain the stability of the financial system and ward off potential financial crises. Central banks set prudential regulations for commercial banks. These regulations include capital adequacy requirements and risk management standards. In simpler terms, banks are required to have a certain amount of capital set aside to absorb potential losses. They are also expected to implement robust risk management systems to identify, measure, and control risks. In addition to setting regulations, central banks also conduct regular inspections and stress tests. These activities are aimed at assessing the financial health of banks. Stress tests, in particular, are designed to see how banks would fare under adverse economic conditions. By performing these roles, central banks ensure that banks operate safely and soundly, contributing to overall economic stability. Let's move on to the final roles of central banks. From printing money to preventing crises, central banks have a lot on their plate. Now let's dive into two of their key responsibilities: currency issuance and financial stability. Currency issuance is rather straightforward. Central banks are the guardians of a country's money supply. They oversee the creation and distribution of banknotes and coins, ensuring the integrity and security of the currency. But it's not just about printing money. They also manage a nation's foreign exchange reserves, a key element in maintaining the value and stability of the currency. And then there's financial stability, a role that is often underappreciated until a crisis hits. Central banks continuously monitor and address systemic risks in the financial system. They act as a safety net, providing support to banks facing liquidity shortages. By doing so, they help prevent financial meltdowns that could ripple through the economy, affecting everyone. Lastly, let's talk about the role of central banks as government advisors. Central banks aren't just financial institutions, they're also key advisors to the government. Picture this: the government needs to make crucial decisions about the country's monetary policy or fiscal policy. Who do they turn to for advice? That's right, the central bank. You see, central banks are equipped with a deep understanding of economic trends, financial markets, and monetary mechanisms. They use this knowledge to provide the government with comprehensive analysis and recommendations on a slew of economic matters. Whether it's setting the right interest rates, managing public debt, or even deciding on tax policies, the central bank's advice is invaluable. But that's not all. Central banks also participate in international forums and collaborate with other central banks worldwide. They work together to coordinate global economic policies and initiatives, ensuring that our financial world keeps turning smoothly. And there you have it, the critical functions of a central bank in an economy. So what have we learned about the role of central banks today? Well, we've found that central banks play an absolutely pivotal role in shaping a country's economic and financial landscape. They influence not just the flow of money and credit through their monetary policy, but also the very pulse of economic activity via interest rates. They set the pace for commercial banks through reserve requirements and engage in open market operations to maintain a balanced level of reserves within the banking system. Central banks stand as vigilant overseers, regulating the banking sector to ensure stability and prevent financial crises. They are the custodians of our currency, ensuring its integrity and security. And they serve as stalwarts of financial stability, providing support in times of crisis and mitigating systemic risks. Lastly, let's not forget their role as government advisors, providing valuable insights on monetary and fiscal policy and other economic matters. Thanks for watching, and remember, understanding how central banks work is key to understanding our economy.